In the year 2000, one man lost more money than any human being in the history of the world. Not a government, not a bank, not a corporation. One man, in 12 months, $70 billion, gone. And the craziest part? He didn't go to prison. He didn't disappear. He didn't even stop working. He just sat down, looked at the wreckage, and started building again. This is the story of how it happened. Not the headline version, the real version. The decisions, the psychology, the market mechanics, and the moment where everything fell apart. Because understanding how someone loses $70 billion teaches you more about money than almost anything else you'll ever hear. To understand the loss, you need to understand what came before it. Because you don't lose $70 billion without first having $70 billion. And the story of how Son built that fortune is just as insane as the story of how he lost it. Masayoshi Son grew up in poverty in southern Japan, the son of Korean immigrants who lived in an illegal settlement, a shantytown, with no legal status and no real future as far as the world around them was concerned. He moves to California at 16, teaches himself English in weeks, gets into UC Berkeley, studies economics and computer science, and in the middle of his college years, in the late 1970s, he starts to feel something that most people around him cannot feel yet. The computer revolution is coming, and whoever positions themselves at the center of it early enough, before everyone else realizes what's happening, is going to accumulate wealth on a scale that hasn't existed before. Son sells a patent to Sharp Corporation for over $1 million while still in college, imports arcade machines from Japan, and makes another $1.5 million. He graduates in 1980, goes back to Japan, and starts SoftBank, a software distribution company. Within 2 years, he controls 50% of Japan's software market. By the mid-1990s, SoftBank is profitable, established, and respected. And then Son looks at the internet, which is just beginning to exist as a commercial product. And he sees the same feeling he had in college, but 10 times stronger. In 1996, Son writes a check for $100 million for a 33% stake in Yahoo. This is a massive, aggressive bet on a company that most traditional investors still don't fully understand. Yahoo is not yet profitable. The internet itself is not yet mainstream. Most of Wall Street is still skeptical. Son doesn't care. He can see where this is going. And then between 1997 and 1999, something happens in financial markets that no one has ever quite seen before. The NASDAQ goes vertical. In 1999 alone, a single calendar year, the NASDAQ rises 86%. 86% in 1 year. For context, a normal good year in the stock market is 10 to 15%. This is almost 6 times that. And it's not driven by profits. It's not driven by revenue. It's driven by a collective belief shared by millions of investors, retail and institutional alike, that the internet is going to change everything, that every company with a .com in its name is going to be worth billions, and that the old rules of valuation simply do not apply anymore. Sound familiar? Son is not just riding this wave. He is one of the people creating it. Between 1994 and 1999, he invests $3 billion across over 800 technology startups. 800 companies. The strategy is simple in concept and extraordinary in execution. Carpet bomb the future. Place so many bets, so aggressively, that the future has to include you somewhere. Some of these bets are going to go to zero. Son knows that. He doesn't care. Because in a market going up 86% a year, even mediocre bets are returning double and triple. And his good bets, Yahoo, the handful of companies that actually have a real product, are going up 10 times, 20 times, 50 times. SoftBank stock becomes one of the most watched in Japan. Every earnings report, every new investment announcement, every deal Son makes sends the stock higher. Institutional investors pour money in. Retail investors pour money in. Japanese pension funds, American hedge funds. Everyone wants exposure to what Son is building. And Son's personal wealth, almost entirely tied to his ownership stake in SoftBank, climbs with it. $30 billion, $50 billion, $65 billion. And then, in February of 2000, on a single morning, SoftBank stock hits a new peak. Masayoshi Son's net worth crosses $78 billion. He is richer than Bill Gates, richer than Warren Buffett, richer than any human being alive, for 3 days. Now here is the part of the story that most people skip over, because what happens next is not just about a market crash. It's about a series of decisions, or failures to make decisions, that turn a correction into a catastrophe. On Friday, March 10, 2000, the NASDAQ hits its all-time peak at 5,048 points. On Monday, March 13th, news breaks that Japan has entered a recession. A global sell-off begins. Tech stocks take the first hit. The NASDAQ falls 2.6% that Monday. Not alarming by itself. Markets correct all the time, but this time, it doesn't stop. Over the following weeks, the selling accelerates. The same psychology that drove the market up, pure momentum, pure belief, detached from fundamentals, now works in reverse. When belief breaks, it breaks fast. By the end of April 2000, the NASDAQ has fallen 25% in a single week, an all-time record that surpassed even Black Monday in 1987. And SoftBank, which had been the most aggressive buyer of internet stocks in the world, is now the most exposed seller in the world. Except Son isn't selling. This is the critical decision. And to understand it, you have to get inside Son's head in those weeks. Son genuinely believes, and this is not self-delusion, this is his sincere conviction, that the internet is going to reshape every industry on Earth. He has been right about this for years. Every skeptic who told him he was crazy had been proven wrong. The valuations were excessive. He knows that. Even at the peak, he isn't telling anyone the prices are rational. But he believes the underlying technology is real. And he believes that if he sells, if he liquidates SoftBank's massive portfolio of internet stocks into a falling market, he will crystallize losses that he could avoid if he just holds. He has seen corrections before. Every correction in the history of the stock market has eventually recovered. So he holds. The problem is that this isn't a correction. It's a fundamental repricing of an entire asset class. Here's what was actually happening inside the companies SoftBank had invested in. Take Webvan. Son had backed this online grocery delivery startup, the 1999 version of Instacart, with hundreds of millions of dollars. Webvan had burned through over $830 million in cash building high-tech warehouses, hiring thousands of employees, and assembling fleets of delivery trucks. Its revenue, tiny, a fraction of what it needed to justify the infrastructure. When the market turned, Webvan's investors stopped propping up the stock. The company burned through its remaining cash. By July 2001, Webvan shut down its website, fired 2,000 employees, and filed for bankruptcy. Or take Kozmo, another SoftBank-backed startup that promised one-hour delivery of anything to your door. Kozmo had raised hundreds of millions of dollars. It was in 11 cities. It had thousands of employees. When investor confidence broke, the company scrambled to raise more capital. Every potential deal fell through. In April 2001, Kozmo pulled the plug, laid off 1,100 employees, and closed permanently. This was happening across Son's entire portfolio of 800 companies. These weren't companies with bad management or bad products. Many of them were genuinely innovative. But they had been built on the assumption of infinite capital, that money would always be available to fund growth until profitability arrived. When the market turned, the capital dried up overnight. And without capital, most of them simply ceased to exist. Son's 50% failure rate across his .com portfolio wasn't because he picked bad companies. It's because the entire model, grow at any cost, worry about profits later, collapsed the moment the stock market stopped believing in it. Meanwhile, SoftBank's own stock is in free fall. At its peak in February 2000, SoftBank's market capitalization was over $180 billion. By the end of 2000, it has fallen to $2.5 billion, a decline of 98%. Son is watching his net worth, which had been $78 billion, Collapse in real time. Every morning he wakes up and checks the numbers. Every morning, billions more are gone. But he still doesn't sell. Because here's the trap he's in. His personal wealth is almost entirely held in SoftBank stock. If he starts selling SoftBank shares into a collapsing market, he accelerates the very decline that is destroying him. Every share he sells signals to the market that even the founder is getting out. He is trapped inside his own position. By the end of 2000, the math is brutal and irreversible. Son has lost approximately $70 billion in personal net worth in 12 months. To put that in numbers your brain can actually process, that is $192 million per day. Every single day for a year. $8 million per hour, around the clock, including weekends. The previous record for the largest personal financial loss in history had never come close to this number. Son didn't just break the record, he obliterated it. And SoftBank as a company is in serious trouble. The portfolio is wrecked. The stock is down 98%. Debt that had seemed manageable when the stock was at its peak is now crushing. Banks start calling. Creditors start asking questions. Son calls a press conference. He walks out in front of the cameras, in front of the Japanese press that had spent months destroying him in print. And he does something almost no billionaire in this situation would do. He apologizes, directly, without excuses, without deflecting blame onto the market, or the Federal Reserve, or the timing, or the investors who had been equally greedy. He looks into the cameras and says, "I was overly optimistic. I made mistakes. I am sorry." He then says he was embarrassed, ashamed, not just for his own losses, but for what his investors had suffered because they trusted him. In a culture where saving face is everything, this was an extraordinary moment. And then he goes back to his desk and starts working. Now you might be asking yourself, how does a person mentally survive this? $70 billion, gone, in a year. Most people who lose even a small fraction of their net worth experience anxiety, depression, paralysis. The psychological weight of financial loss is documented across decades of behavioral economics research. People make worse decisions after losses. They become risk-averse at exactly the moment when risk-taking would help them recover. They chase losses, or they freeze entirely. Son does neither. He later explains his thinking in a way that sounds simple but is actually very difficult to execute. He separates the loss from the thesis. The thesis was, the internet changes everything. Software eats the world. Information technology is the most powerful economic force of the next century. Was that thesis wrong? No, it was right. It is still right. Amazon survived the dot-com crash and became the most valuable retailer in history. Google launched in this period and became one of the most powerful companies ever built. The internet did change everything, just not at the pace and valuation that the market had priced in during 1999. The loss was real. The valuations were insane. Many of the individual companies were built on sand. But the underlying thesis, Son had been right. And as long as the thesis is right, the loss is tuition, not a verdict. That distinction between a bad outcome and a wrong thesis is what allows Son to do what he does next. While he is sitting in the wreckage of a $70 billion loss, still managing a company whose stock is down 98%, still fielding calls from creditors and journalists and investors who think SoftBank is finished, he gets introduced to a former English teacher from China named Jack Ma. Ma has an idea for an e-commerce platform. No revenue, no business plan. Rejected by virtually every other investor in the world. Son meets him for 10 minutes and writes a check for $20 million. His advisors think he has completely lost his mind. The man just lost $70 billion on internet companies, and now he is writing a check to another internet startup in communist China, run by a man with no track record. In 2014, that $20 million becomes $60 billion. The largest return on a single venture investment in the history of Silicon Valley. Son didn't just survive the $70 billion loss. He used it as the foundation for the greatest comeback trade in financial history. So what does this story actually teach us about money? First, paper wealth is not real wealth until you sell. Son's $78 billion at the peak of the dot-com bubble was almost entirely paper, SoftBank stock at bubble-era valuations. He never locked it in. He never diversified. He held, and when the market repriced, the paper evaporated. The lesson isn't that you should always sell. It's that you should always know the difference between what you own and what you can actually spend. Second, concentration is a weapon that cuts both ways. Son's extraordinary wealth was built because he was massively concentrated in SoftBank and its portfolio. That concentration also meant that when the market turned, there was no hedge, no diversification, no safety net. The same bet that made him the richest person on earth wiped out 98% of his net worth in 12 months. Concentration creates the potential for generational wealth. It also creates the potential for generational loss. There is no version of this story where you get the upside without accepting the downside. Third, the most dangerous moment in any bubble is when the thesis is real, but the valuation is wrong. Son wasn't delusional about the internet. He was right about the internet. The problem was that in 1999, the market was pricing in a future that was real, but was 10 years away, not 10 months away. And there is almost no way to distinguish, in the moment, between a temporary overvaluation and a permanent one. This is the trap that catches sophisticated investors far more often than naive ones. The naive investor gets into a bubble because he doesn't understand valuation. The sophisticated investor stays in a bubble because he understands the underlying thesis too well. Fourth, and this is the one that matters most, how you respond to a catastrophic loss determines everything that comes after it. Son lost more money than any human being in history. He didn't blame others. He didn't hide. He stood in front of cameras and said he was wrong. And then he went back to work with the same intensity, the same conviction, and the same willingness to make big bets in the middle of uncertainty. Most people who lose everything become permanently risk-averse. The loss rewires their psychology, and they spend the rest of their lives protecting what little they have left. Son used the loss as data, updated his models, and placed the next bet. That's not a financial lesson. That's a character lesson. And it may be the most valuable one in this entire story. If you want to understand how the biggest fortunes in the world are really built and really lost, subscribe. Because this channel exists for exactly that. Next week, we're going deeper into the mechanics of how bubbles form and why smart people keep getting caught inside them. I'll see you there.